Howdy, Jacob here. Today we are looking at Duke Energy Corporation. Huge company, $71.5 billion market cap, $142.5 billion enterprise. So, what is that? Is it over double? Not quite. All right. So, almost double the enterprise value as market cap. And we're talking about a $71 billion company in the electrical utilities industry. So return on invested capital, pretty trashy, 3%. Makes sense why there's such a big dividend, 4.38% yield. Gross margins look pretty attractive, 40s improving to mid 40s. Operating margins from 23%, 22%, pretty good there. Payout about what is right now? $4.06. That's a pretty high payout. Let's look at the balance sheet first. So long-term debt, $66 billion in long-term debt. Ooh, that is over 20 times earnings, and oh my god, they haven't had a positive year of free cash flow since 2014 because their capital expenditures has been so great. Oh my god, I've never been so turned off by a stock before. Oh my gosh. Okay, so they don't produce any cash. They go into debt to pay for everything that they can't actually afford because their capital expenditures is what is used to keep the business afloat. And if there's any electrical, because it's electrical utilities, if any system is down, it's just to make sure that everything's working properly. It's not even expanding the business. It's just to keep it in business. So they've invested so much into the business, it now costs over $10 billion just to keep all of the assets that they have working properly so they can produce more cash, but they can't produce more cash than what they're utilizing in paying for capital expenditures. So, ooh, that is ugly. They have not bought back debt in 10 years. They've only gone up from 36 billion to 66 billion, and they went from making $1 billion in free cash flow pretty much to losing $4 billion. I mean, they can't afford this dividend because dividends are paid out of cash flow. That's why you can see that, oh, their net income's so great, 2.5 billion, 3.9 billion, that's fantastic. But you can see that they're going into debt because they can't afford these dividends with the cash that's actually being produced by the business after paying for capital expenditures. So I don't even know how to calculate the free cash flow margin since the only thing I could say is to buy it out, but they have so much debt that the assets aren't much. 112 versus 126 in total liabilities. That's not even liquidating it would be productive. I feel like it's such a big company that I don't see it going out anytime soon. It's not going to get thrown out or go under per se, likely. I'm not predicting anything, but I would presume it won't just because it's a $71 billion company. But there's so much debt and they make no money on a free cash flow basis that I don't even know. I'll just throw in some assumptions here that are fugazi. It doesn't exist. It's fairy dust. Okay, great. I can put in 10 and then here like 2. I don't. They've been increasing shares a little bit. Yeah. They don't make cash flow, so they can't afford this dividend, which is exactly what this screen is looking for. And so this is a company I would just avoid. And that's why it's probably a great company for dividend traps where people see a 4.4% yield and go, oh, this is fantastic. But they don't dig into the balance sheet. They don't dig into the cash flow statement to realize that they're going into debt just to pay for the dividends. And now their debt is almost double what their market cap is. Or exactly, that was exact. Their enterprise value is almost double what the market is. So their debt is almost the same as their market cap. Okay, well, shortcut vid. Hope everyone has a good rest of their day. Thank you.